It is time for Portfolio Management Part 2. Okay, study session 13, Portfolio Management Part 2. This study session introduces the portfolio planning and construction process, including the development of an investment policy statement, the IPS, a discussion of risk management, including the various types of measures of risk, follows, and of risk management frameworks is provided. This section concludes with a coverage of how financial technology or fintech is impacting areas within the investment industry, such as the investment analysis, automated advice, and risk management. Reading assignments, reading 41. Basics of portfolio planning and construction, reading 42 about risk management introduction, and reading 43 about fintech or financial technology and investment management. Quite an interesting section. We'll be getting into reading 41, basics of portfolio planning and construction learning outcome. The candidate should be able to describe the reasons for writing an investment policy statement, an IPS, describe the major components of an IPS, describe risk and return objectives and how they may be developed for a client, distinguish between the willingness and ability or capacity to take risk in analyzing an investor's financial risk tolerance, describe the investment constraints of liquidity, time horizons, time concerns, legal and regulatory factors, and unique circumstances and their implications for the choice of portfolio assets. Explain the special specifications of asset classes in relation to asset allocation. Describe the principles of portfolio construction and the role of asset allocation in relation to IPSs. IPSs, once again, is referring to investment policy statements. Introduction. To build a suitable portfolio for a client, investment advisors should first seek to understand the client's investment goals, resources, circumstances, and constraints. Investors can be categorized into broad groups based on the shared characteristics with respect to these factors. Even investors within a given type, however, will invariably have a number of distinctive requirements. In this reading, we consider in detail the planning for investment successes based on an individualized understanding of the client. This reading is organized as follows. Section 2 discusses the investment policy statement, a writing document that captures the client's investment objectives and the constraints. Section 3 discusses the portfolio construction process, including the first step to specifying a specific strategic asset allocation for a client. A summary on practice problems concludes the reading. Portfolio planning. Portfolio planning can be defined as a program developed in advance of constructing a portfolio and that is expected to safety and client's investment objectives. To satisfy the client's investment objectives, the written document governing this process is the investment policy statement, the IPS. The investment policy statement, the IPS, is a starting point of the portfolio management process. Without a full understanding of the client's situations and requirements, it is unlikely that successful results will be achieved. Success can be defined as a client achieving his or her important investing goals using means that he or she is comfortable with in terms of risk taking or other concerns. The IPS essentially communicates a plan for achieving investment success. The IPS will be developed following a fact-finding discussion with the client. This fact-finding discussion can include the use of questionnaires designed to articulate the client's risk tolerance as well as specific circumstances. In the case of institutional clients, the fact may involve assets, liabilities management studies, identification of liquidity needs, and a wide range of tax and legal considerations. The IPS can take a variety of forms. Typical format will include the client's investment objectives and the constraints that applies to the client's portfolio. The client's objectives are specified in terms of risk tolerance and return requirements. These must be consistent with each other. A client is unlikely to be able to find a portfolio that offers a relatively high unexpected return without taking a relatively high level of risk. Okay, I'm drinking water, just plain old water today, but with cinnamon powder and apple juice inside. So a veilingly faint taste. It's kind of a channel tradition to talk about what I'm drinking today. Oh, and by the way, the channel show notes are in the description below. It's on Amazon. You can go head down to Amazon. Okay, enough tangent. The constraint section covers factors that need to be taken into account when constructing a portfolio for a client that meets their objectives. The typical constraint categories are liquidity requirements, time horizons, regulatory requirements, tax status, and unique needs. The constraints may be internal or external. These are discussed in detail below. Having well-constructed IPS for all clients should be a standard procedure for a portfolio manager. The portfolio manager should have an IPS close at hand and be able to refer to it to assess the suitability of a particular investment for the client. In some cases, the need for IPS goes beyond simply being a matter of standard procedure. In some countries, IPS or equivalent documents is a legal or regulatory requirement. For example, UK pension schemes may have a statement of investment principles under the Pensions Act of 1985, and the statement is an essence of the IPS. The UK Financial Conduct Authority, the FCA, has a requirement for investment firms to know their short customers, or quote unquote know their customers. The European market and financial instrument directives, the MiFID, requires firms to assign clients to categories such as professional clients and retail clients. In the case of institutions such as pension plans or university endowments, the IPS may set out the governance arrangements that apply to the investment funds. For example, these information could cover the investment committee's approach to appointing and reviewing investment managers for the portfolio and the discretion that those managers have. The IPS could also set out to institutions' approach to corporate governance in terms of how it will approach the use of shareholder voting rights under the forms of engagement with corporate management. The IPS should be reviewed on a regular basis to ensure that it remains consistent with the client's circumstances and requirements. For example, the UK pension regulator suggests that pension schemes' statements of investment principles, a form of IPS, should be reviewed at least every 3 years. The IPS should also be reviewed if the manager becomes aware of material changes in the client's circumstances or on the initiative of clients when his or her objectives, time horizons, or liquidity needs changes. Major components of the IPS. There are no single standard for format of IPS. Many IPS, however, includes the following sections: an introduction, statement of purpose, the statement of duties and responsibilities, the procedures, investment objectives, investment constraints, investment guidelines, evaluations and reviews, and appendixes. The section that most closely links to the customer's distinctive needs and probably the most important from a financial planning perspective are they dealing with the investment objectives of the constraints. In this following section, we discuss the investment objectives and constraints format for an IPS, beginning with the risk and return objective. We follow tradition of CFA Institute presentations in discussing how risk objectives first. The process of developing the IPS is the basic mechanism for evaluating and trying to improve an investor's overall expected return. Risk stance in a portfolio context. Investors have learned to appreciate their own objectives. Is not to manage reward, but to control and manage risk. Stated otherwise, return objectives and expectations will be tailored to be consistent with risk objectives. The risk and return objective must be consistent with the constraint that apply to the portfolio. Risk objectives. When constructing a portfolio for a client, it is important to ensure that the risk of the portfolio is suitable for the client. The IPS should state clearly the risk tolerance of a client. Risk objectives are specifications for portfolio risk that reflects the risk tolerance of the client. Quantitative risk objectives should be absolute or relative or a combination of two. Examples of an absolute risk objective would be a desire to suffer any loss of capital or not to lose more than a given percentage of capital in any 12-month period. Note that these objectives are not related to investment market performance, good or bad, and are absolute in the sense of being self-standing. The fulfillment of such objectives can be achieved by not taking any risk, for example, by investing in an insured bank certificate or a deposit of credit-worthy bank. If investments or risky assets are undertaken, however, such statement would need to be restated as a probability statement to operationals. To be operational. For example, the desire not to lose more than 4% of the capital in any 12-month period might be restated as an objective to that 95% probability that the portfolio may not lose 4% in the next 12-month periods. Measures of absolute risk include the variance of standard deviation of returns and value of risk. Some clients may choose to express relative risk objectives, which relates risk relative to one or more benchmarks perceived to represent appropriate risk standards. For example, investments in large cap UK equities could be benchmarked to an equity market index, such as the FTSE 100 index. The S&P 500 index could be used as a benchmark for the large cap U.S. equities, or for investments with cash-like characteristics. The benchmark could be an interest rate, such as labor or treasury bill rates, for risk relative to benchmark. The relevant measures is tracking risk or tracking errors for institutional clients. The benchmark may be linked to some form of liability the institution has. For example, a pension plan must meet the pension payments as they come due, and the risk objectives will be to minimize the probability that it will fail to do so. When a policy portfolio is used, the risk objective may be expressed as a desire for the portfolio return to be within a band of plus or minus X% of the benchmark return, calculated by assigning an index or benchmark to represent each asset class present in the policy portfolio. Again, the objective has to be interpreted as a statement of probability. For example, a 95% probability that the portfolio return will be within X% of a benchmark return over a stated time period. For example, one review this material. Okay. The client's overall risk tolerance is a function of the client's ability to bear or accept his or her own risk attitudes, which might be considered as the client's willingness to take risk for ease of expression. From this point on, we will refer to the ability to bear risk and the willingness to take risk as the two components of risk tolerance. Above average ability to bear risk and above average willingness to take risk implies above average risk tolerance. Below average ability to take or bear risk and below average willingness to take risk implies below average risk tolerance. Quite straightforward. The ability to bear risk is measured mainly in terms of objective factors such as time horizons, expected income, and the level of wealth relative to liabilities. For example, an investor with 20 years of time horizon can be considered to have a greater ability to bear risk, other things being equal, than an investor of 2-year horizons. The difference is because 20 years is more scope for losses to be recovered or other adjustments to circumstances to be made than if it's over 2 years. Similarly, investors whose assets are comfortably in access and their liabilities have more ability to bear risk than an investor whose wealth is expected future expenditures and more closely balanced. For example, a wealthy individual who can sustain a comfortable lifestyle after very substantial investment losses has a relatively high ability to bear risk. A pension plan has a large surplus of assets over liabilities, has a relatively high ability to bear risk. Risk attitude or willingness to take risk is a more subjective factor based on the client's psychology or perhaps his or her current circumstances. Although the list of factors that are related to an individual's risk attitude remains open to debate, it is believed that some psychological factors such as personality type, self-esteem, and inclinations to independent thinking are correlated with the risk attitude. Some individuals are comfortable taking financial and investment risk, whereas others find it distressing. Although there is no single agreed upon method for measuring risk tolerance, willingness to take risk may be gauged by discussing risk with the client or by asking the client to complete a psychometric questionnaire. For example, financial planning academic John Garbo and the collaborators have developed 13 items and 5 items risk attitude questionnaires that have undergone the same level of technical validation. The 5-item questionnaires are shown in Example 1. Investing is too difficult to understand. I am comfortable putting my money in a bank account until than a stock market. I would think the word risk is less comes to mind immediately. Making money in stocks and bonds is based on luck. In terms of investing, safety is more important than returns. These are good questions to gauge investors' potential risk tolerance and risk acceptance. The responses, this is what it looks like. In the institutional context, there could be a conflict between the ability and willingness to take risk. In addition, different stakeholders within the institution may take different views. For example, the trustee of a well-funded pension plan may desire a low-risk approach to safeguard the funding of the schemes, and beneficiaries of the schemes may take a similar view. The sponsors, however, may wish a higher risk-return approach to an attempt to reduce future funding costs. With a trustee bears a fiduciary responsibility to pension beneficiaries and the interests of the pension sponsors and the pension beneficiaries' conflicts, the trustee should act on the best interests of the beneficiaries. When abilities to take risk and willingness to take risk are consistent with the investment advisor's task is the simplest. When the ability to risk to take risk is above average and the willingness to take risk is above average, the investor's tolerance should be assessed below the average overall. When ability to take risk is above the average but willingness is above the average, the portfolio manager or advisor may seek consult to the clients and explain the conflicts and disimplications. Let me drink my water. For example, the advisor can outline the reasons why the client is considered to have a high ability to take risk and explain the likely consequences in terms of reduced expected returns of not taking risk. The investment advisors, however, should not aim to change a client's willingness to take risk, that it is not a result of miscalculations or misperceptions, modifications of elements of personality. Is not within the purview of the investment advisor's role. The prudent approach is to reach a conclusion about risk tolerance consistent with the lower of the two factors, ability and willingness, and to document the decisions made. Example 2 is the first of the set of the following that follows the analyst to private wealth management. Client drew preparations of the major elements of the IPS, of the initial public offer. Quite an interesting example. I read it. It's quite interesting. You can just pause the video and read it. Here's an example. And here's the other example. The risk tolerance. Okay. Return objectives. The client's return objectives has been stated in a number of ways, similar to risk objectives. Return objectives may be stated on an absolute or relative basis. As an example of absolute objectives, the client may want to achieve a particular percentage rate of return. For example, X percent. This can be a nominal rate of return or be expressed as real inflation-adjusted terms. Alternatively, the return objectives can be stated on a relative basis. For example, relative to a benchmark return. The benchmark could be an equity market index such as the S&P 500 or the FTSE 100, or cash rate of interest such as LIBOR, or LIBOR may be appropriate when the investor has some liabilities that is linked to the rate. For example, a bank that has a particular cost of funding linked to LIBOR, relative return objective might be stated as, for example, a desire to output the benchmark index, to outperform a benchmark index or by 1% point per year. Some institutions have set their returns objectives relative to the peer groups or a universe of managers. For example, an endowment aiming to return a return that is the top 50% of returns of similar institutions, or a private equity mandate aiming for a return in the top quartile among the private equity universe. This objective can be problematic with limited information, as knowing about the investment strategies or the returns calculation methodology being used by peers. And we must bear in mind the impossibility of all institutions being above average. Furthermore, a good benchmark should be investable, that is able to be replicable by the investor, and a pure benchmark typically does not meet that criteria. In each case, the return requirement can be stated before or after fees. Care should be taken that the fees basis under the used is clear and understood by both the manager and client. The return could also be stated on either a pre- or post-tax basis when the investor is required to pay tax. For taxable investors, the baseline is to state and analyze returns on an after-tax basis. The return objective could be required return, that is the amount that the investor needs to earn to meet the particular future goal, such as a certain level of retirement income. The manager or advisor must ensure that the return objective is realistic. Care should be taken that clients and managers are in agreement on whether the return objective is nominal or real. As also with the current economic and market environment, for example, a 15% nominal return might be possible with inflation when inflation is 10%, but will be unlikely when inflation is 3%. When a client has unrealistic returns expectations, the manager or advisor would need to consult them about. This is so funny, man. What's the CFA program up to, man? When the client has unrealistic return expectations, go to Wall Street Bets, man. The manager or advisor will need to consult them about what is achievable in the current market environment. Hey man, I'm sorry man, your returns are unrealistic. Imagine an advisor from like Citibank telling you that. And within the client's tolerance of risk. All right, in the following section, we analyze 5 major types of constraints on the portfolio selection: liquidity, time horizon, tax concerns, legal and regulatory factor, and unique circumstances. Liquidity, the IPS should state what the likely requirements are to withdraw funds from the portfolio. Examples of individual investors with an outlay for covering healthcare payments or tutoring tuition fees for institutions. It could be spending rules on requirements for endowment funds, the existence of claims coming due in case of property and casualty insurance or benefit payments for pension plans and life insurance companies. When the client does have such a requirement, the manager should allocate part of the portfolio to cover the liability. This part of the portfolio will be invested in assets that are liquid, that is easily converted to cash and low risk at a point in time. The liquidity needs to actually present so that the value is known with reasonable certainty. For example, the asset allocation in the insurance portfolio of fintech insurance sample shows a large allocation of fixed income investments, some of which are either high liquidity or have a short maturity. These investment enables the company, in case of the property and causality insurance, to pay out the potentially lumpy claims of which the timing is unpredictable. In the case of a life insurance, to pay out the life benefits, the size and timing of which are more predictable and can therefore be matched with the maturity profile and fixed income portfolio. Okay. Time horizon. The IPS should state the time horizon over which an investor is investing in. It may be the period of time which the portfolio is accumulating before the asset needs to be withdrawn. It could also be a period until the circumstances are likely to change. For example, a 50-year pension plan investors hoping to retire at 60 has a 10-year horizon. The portfolio may not be liquidated at age 60, but its structure may need to change. For example, as the investor begins to draw on income from the fund, the time horizon of the investor will affect the nature of investment used in the portfolio. Illiquid or risky investments may be unsuitable for an investor with a short time horizon because the investor may not have enough time to recover from investment losses. For example, such investment, however, may be suitable for an investor with a longer horizon, especially if the risky investment are expected to have higher returns. Tax concerns. Ooh, scary Uncle Sam is coming to get your money. Okay, the IRS. Nobody likes them. Tax status varies among investors. Some investors will be subject to taxation on investment returns, and some will not. For example, in many countries, returns... Yeah, okay. In many cases, portfolios should reflect the tax status of the clients. For example, a taxable investor may wish to hold the portfolio that emphasizes capital gains and receive little income. A taxable investor based in the U.S. is also likely to consider including U.S. municipal bonds or MUNIS in his or her portfolio because interest income from MUNIS, unlike the Treasury and corporate bonds, is exempt from taxes. Wow, really? Oh, I didn't know that. That's quite interesting. The tax-exempt investors, such as a pension fund, will be relatively indifferent to the forms of returns. Legal and regulatory factors. The IPS should state any legal or regulatory restrictions that constrain how the portfolio is invested. In some countries, some institutional investors and pension funds are subject to restrictions on the composition of the portfolio. For example, there may be limitations on the proportions of equity or other risk assets in the portfolio, or on the proportions of the portfolio that may be invested overseas. The U.S. has no limits on pension funds asset allocation, but some countries do. Examples of a percentage of assets that can be invested in securities issued by the plan sponsors or self-investment limits are as such. Okay. Wow, India is kind of strict, man. Okay. When an individual has access to material non-public information about a particular security, the situation may also form a constraint. For example, the directors of a public company may need to refrain from trading the company's stock at certain points of the year before financial results are published. The IPS should note the constraints so that the portfolio manager could not inadvertently trade the stock on the client's behalf. Ooh. Imagine doing insider trading unknowingly. Lamau. Unique circumstances. This section of the IPS should cover any other aspects of the client's circumstances that is likely to have a material impact on the composition of the portfolio. A client may have considerations derived from his or her religion or ethical values that could constrain investment choices. For instance, Muslims investors seeking compliance with Sharia law or Islamic law or avoid investing in businesses and financial instruments that is inconsistent with Sharia. Some casinos and bonds, because Sharia prohibits gambling and lending money on interest. Really? Muslims can lend money on interest? Darn, those Saudis, man. Similarly, a Christian investor may wish to avoid investing in investments he or she believes are inconsistent with their faith. Whether rooted in religious belief or not, clients may have personal objections to certain products, which could lead to exclusions of certain companies, countries, and types of securities. And for the investable universe as well as the client benchmark, such considerations are often referred to as the ESG, and investing in accordance with such considerations is referred to as the SRI, the socially responsible investing. Ah, how wholesome. Alright, so here's some negative criteria. Tobacco, alcohol, gambling, pornography, manufacturings of cells of weapons, unnecessary exploitations of who exploits animals? No, nuclear power, poor environmental practices, human rights. Okay, so these are all things that, people don't really like to invest in. I mean, who wants to invest in companies that abuses animals? Okay, when a portfolio represents only part of the client's total wealth, there may be aspects or proportions of wealth under the control of the manager that has implications for the portfolio. For example, an employee of a public company whose labor income and retirement income provision are reliant on the company, and who may be a substantial investment exposure to the company through employee share options and stock holdings, may decide that his or her portfolio should not invest additional amounts in the stock. An entrepreneur may be reluctant to see his or her portfolio invested in the shares of competing businesses or in another business that has risk exposures aligned with his or her entrepreneurial ventures. A client's income may rely on a particular industry or asset class. Appropriate diversification requires an industry or asset class to be de-emphasized in a client's investment. For example, a stockbroker should consider to have a relatively low weighting in equities, as his skills and thus income generating ability are worth less than the equities and do not perform well. Employees should similarly be wary of having concentrated share positions in the equity of the company they work for, and the employer encounters difficulties. Not only may the employee lose his or her jobs, but their investment portfolios could also suffer a significant loss of value. Gathering client information, as noted above, it is important for portfolio managers and investor advisors to know their clients. For example, Dutch security industries practices requires financial intermediaries to undertake substantial fact-finding. This is required not only in the case of full-service wealth management or in the context of the IPS, but also in lighter form financial intermediation, such as advisory relationships, or execution-only relationships. An exercise in fact-finding about this customer should take place at the beginning of the client's relationship. This will involve gathering information about the client's circumstances as well as the discussion of the client's objectives and requirements. Excuse me. Important data to gather for the client should cover a family of employment situations as well as financial information. If the client is an individual, this will be necessary to find the situation and requirement of the client's spouse or other family members. The health of the client and his or her dependent on also varying relevant information. In an institutional relationship, It will be important to know about your key stakeholders in the organization and what their perspectives and requirements are. Information gathering may be done in an informal way, or maybe involve structure, interviews or questionnaires or analysis of data. Many advisors will capture data electronically and use specialized systems to record data and produce customized reports. Good report keeping is very important and may be critical in the case of in which any aspect of a client's relationship comes into dispute in later stages. Let me drink my water. Man, fruity water is just the best. Okay. Example 5, example 8, the final one of the Henry Gascon shows the information obtained from the fact finding exercise may be incorporated into the objectives and constraints section of the IPS. Portfolio construction. Once the IPS has been compiled, the investment manager can construct a suitable portfolio. Strategic asset allocations in the traditional focus of the first steps in portfolio construction. The strategic asset allocation is stated in terms of percent allocations to asset classes. The asset class is a category of assets that have similar characteristics, attributes, and risk-return relationships. The strategic asset allocation is the set of exposures to IPS permissible asset classes that is expected to achieve the client's long-term objectives given the client's risk constraints. The focus of the SAA is the result of a number of important investment principles. One principle is that portfolio systematic risk accounts for the most of its changes and value over the long-term. Systematic risk is risk related to the economic system that cannot be eliminated by holding a diversified portfolio. The risk is that different from particular risk of individual securities, which may be avoided by holding other securities with offsetting risk. The second principle is that the returns to groups of similar assets predictably reflect exposure to a certain set of systematic factors. Thus, SAA is a means of providing the investor with exposure to the systematic risk of asset classes in proportion to meet the risk and return objectives. The process of formulating a strategic asset allocation is based on the IPS. Already discussed the capital market expenditures introduced in section 3.1. How to make a strategic asset allocation operations with a rebalancing policy with a translation into actual investment portfolios will be described in section 3.3. Section 3.4 lists some alternatives to approach chosen and described some portfolio construction techniques. 3.1 capital market expectations. Capital market expectations are the investor's expectations concerning their risk and return prospects of asset classes. However, broadly or narrowly, the investor defines those asset classes when associated with the client's investment objectives. The result is a strategic asset allocation that's expected to allow the client to achieve his or her investment objectives. Traditionally, capital market expectations are quantified in terms of asset class expected returns, standard deviation of returns, and correlation among pairs of asset classes. Formally, the expected returns of an asset class consists of the risk-free rate and one or more risk premiums associated with the asset class. Expected returns are in practice developed in various ways, including the use of historical estimates, economic analysis, and various kinds of valuation models. Standard deviation and correlation estimates, and frequently based on historical data. The strategic asset allocation. Traditionally, investors have designated cash, equities, bonds, and real estate as the major asset classes. The list has been expanded with private equity, hedge funds, and commodities. In addition, such assets are as arts and intellectual property rights may be considered asset classes for investors prepared to make a more innovative approach to and accept some liquidity. Combining such a new asset class as well as a hedge fund and private equity under the header alternative investments have become accepted practice. Alternative investments. We have another section in the CFA Level 1 program curriculum all about alternative investments. By the way, my show notes for the CFA Level 1 program curriculum and Level 2 and Level 3 program curriculums are in the description below. You can go on Amazon and you get the show notes. Yeah. When defining asset classes, a number of criteria apply intuitively. An asset class should contain a relatively homogeneous assets with while providing diversification relative to other asset classes. In statistical terms, risk and return expectations should be similar to a paired correlation of assets should be relatively high within an asset class, but should be lower versus assets in other asset classes. Also, the asset class, while being mutually exclusive, should add up a sufficient approximation of the relevant investable universe. Applying these criteria ensure that the strategic asset allocation process has considered all available investment alternatives. Ooh, scary. What is this graph about? Okay, you can read specifying asset classes. Lamau. Using correlation of matrices, example 9 tends to indicate the only emerging markets were well differentiated from European equities. So, why investors still often subdivide equities. Apart from any regulatory reasons, one explanation might be the decomposition of smaller asset classes corresponds to the way of asset allocation structured in portfolios. Many investment managers have an expertise expressively in specific areas of the market, such as emerging market equities, U.S. small cap equities, and international investment grade credit. Bringing the asset class definition of asset allocation in line with the investment product actually available in the market may simplify matters. From an organizational perspective, the risk-return profile of a strategic asset allocation depends on the expected return and risk of the individual asset class, as well as a correlation between those asset classes in general. Adding asset classes with low correlation improves the risk-return trade-off, as long as the standalone risk of such asset classes do not exceed its diversification effect. Typically, the strategic asset allocation for risk-adverse investors will have a large weight in government bonds and cash, whereas those with more willingness and ability to take risk will have more of the assets in risky asset classes, such as equities and many types of alternative investments. Statistic asset allocation results from combining a constraint and objectives articulated in the IPS and long-term capital market expectations regarding the asset classes. The statistic asset allocation or policy portfolio will subsequently be implemented into real portfolios. Exhibit 6 illustrates conceptually how investment objectives and constraints and long-term capital market expectations combine into a policy portfolio. In some frameworks used in practice, the asset allocation is an integral part of the investment policy statement. This presentation, however, keeps the asset allocation separate from the investment policy statement because clients' investment objectives and constraints, qualifications, are different. How will capital market expectations and investment objectives and constraints eventually translate into a strategic asset allocation? In general, investors choose from a range of asset allocations with a similar return, would prefer those with lower risk. Choosing from allocations with similar levels of risk, investors would prefer those with the highest return. Formally, investors with return objectives can be described as the utility function, in which utility increases with higher expected returns. And lower risk, the assumption that expected utility is increasing in expected return and decreasing in variance of return could yield an expected utility equation such as shown below. The resulting portfolios can be represented as a scattered dots in a chart depicting their risk and expected return. Once again, this is quite intuitive, as the portfolio's risk is a positive function of the risk of its assets and the correlations among them. The portfolio consisting of low correlated risky assets has lower risk than one with a similarly risky asset with higher correlation. It is therefore possible to conduct different portfolios with equal expected returns, but with different levels of risk. The line that connects these portfolios with the minimum risk of each level of expected return is the efficiency frontier. All right. Both the efficiency frontier and the range of wait, what is the efficiency frontier? I think I missed that. Clearly, the efficiency frontier will move upwards, and more lowly correlated assets will suffer from. Okay. Both the efficiency frontier and the range of indifference curves can be plotted in the risk-return space. In Exhibit 7, the downward curve that are concave from below represents efficient frontier association with different assumed expected returns. The upwards from convex curves are indifference curves. The point where the indifference frontier intersects with the indifference curves with the highest utility attainable represents the optimal asset allocation for the client/investor. In Exhibit 7, efficiency frontier 1 has a point in tangency with indifference curve 1. Higher levels of utility, such as those associated with indifference curve 0, can apparently not be reached with an asset underlying the efficiency frontier. It is clear that when capital market expectations change, this change moves the efficiency frontier away from its original location. In the chart, this moves it's illustrated by the efficiency frontier 2, which incorporates different capital market expectations. The new efficiency frontier has a point in tangency with indifference curves 2, which is associated with a lower level of expected utility. Because the point of tangency represents the strategic asset allocation, it implies the asset allocation should be adjusted. Similarly, should investment objectives or constraints change, the indifference curves will change their shape and location. This change will move the point of tangency, and hence change the asset allocation. Okay. So yeah, that's the strategic asset allocation efficiency frontier. This framework describes how investors' objectives and capital market expectations should theoretically be reconciled. It will, however, not be exact procedures that in practice will be followed. First, the IPS does not necessarily translate the client's investment objectives and constraints into a utility function. Rather, the IPS gives threshold levels for risk and expected returns combined with a number of additional constraints that cannot be captured in the model. Second, the model illustrated is a single period model, whereas a practice constraints from IPS will make it inappropriate to use a multi-period model. Multi-period problems can be more efficiently addressed using simulations. Steps towards an actual portfolio. The strategic asset allocation in itself does not yet represent an actual investment portfolio. In the first step, implementing the investment strategy, the quantitatively oriented portfolio managers, the next step is often risk budgeting. As used in this reading, risk budgeting is the process of deciding on the amount of risk to assume in a portfolio. And subdividing the risk over the resources of investment returns, because the decision about the amount of risk to be taken is made in constructing the IPS. At the stage where we are concerned about the subdivision of the risk, apart from exposures to systematic risk factors specified in the strategic asset allocation, the returns of investment strategy depends on two other sources: tactical asset allocation and security selection. Tactical asset allocation is the decision to deliberately deviate from the policy exposure to systematic risk factors with the intent to add value based on the forecast of the near-term returns of these asset classes. For instance, an investor may decide to temporarily invest more of the portfolio in equities that SAA prescribes if the investor anticipates that equities will deliver a higher return over the short term than other asset classes. Security selection is an attempt to generate higher returns than the asset class benchmarks by selecting securities with a higher expected returns. For example, an investment manager may decide to add more IBM stocks to his portfolio. IBM? Seriously? Sure. Then the weights in his equity benchmark. If he expects the stock to do better than a benchmark, the fund just purchased He may sell other stocks expected to do worse and enter the benchmark or IBM. Obviously, deciding to deviate from policy weights or to select securities aiming to beat the benchmark creates additional uncertainty about returns. The risk is over. This risk is over and above the risk inherent in the policy portfolio. Hence, the investment policy should set risk limits and diversify payoffs for each of these three activities. Risk budgeting implies that a portfolio manager has to choose for every asset class whether to deploy security selection as a return generator. This choice is generally referred to as the choice between active or passive management, contrary to strategic asset allocation, where exposures to sources of systematic risk are selected and seized. Security selection is not rewarded with a long-term payoff to risk. Security selection is a zero-sum game, and all investors in an asset class competing with each other to identify a typically limited number of assets that are misvalued in total. The gross return of all market participants average out in the market return. This implies that the average active investor will match the market return, and that one investor gains versus the market return is the other investor's loss versus the market return. However, because the active managers tend to trade more and have to pay people, including themselves, to generate investment ideas or information lending to such ideas, the average active manager will underperform the market net of costs. This does not imply, however, that there are no skillful investment managers who, with some consistency, beat the benchmark. Neither does it imply that all passive managers will be able to match the benchmark. The higher the turnover of indexes, the more trading costs a passive manager will incur, making the task of efficiently mimicking an index more difficult. The likelihood of adding a significant amount of value from security selection depends on the skill of the manager and the informational efficiency of the market for the asset class his skills relates to. The more efficient an asset class or a subset of an asset class, the more skillful an asset manager has to be added value. Broadly speaking, an efficient market is a market in which prices on average very quickly reflect newly available information that requires a sizable participation of means variance optimizing investors acting on rational expectations using the same or using the same or similarly pricing models and having equal opportunities to access relevant information. Clearly, the market of U.S. large capitalization equities will be quite efficient. By contrast, some regional bonds and equity markets do not have the technical and regulatory systems for informational dissemination and are sufficient to serve all investors on a timely basis. Skilled managers should be able to exploit the resulting of inefficiencies. Okay. Additional portfolio organization principles, the top-down oriented framework laid out in earlier paragraphs is quite general. Other methods of portfolio organizations are also used in practice, and those are described briefly here. In addition, this section introduces some portfolio construction concepts in use to better capture the value of active management. According to some practitioners, a top-down investment process, as described earlier, has two drawbacks. They both result from the fact that the top-down process, a multitude of specialized managers may work to the same client within the same asset class. Each of these managers will manage risk versus the client's benchmark, and because these benchmarks are maybe similar or to an overlapping with those investment managers, and the aggregate of all the portfolios within one asset class may be less active than was intended. The resulting investment portfolio may underutilize the risk of budget. Another drawback is that the investment manager each engage in trading over the full extent of the portfolio. The aggregate of all portfolios may not be efficient. For a capital gains point of view, more trading results in more capital gains being realized, increasing the tax bill at the end of the year. To circumvent these issues, the course state-to-light approach was developed. In this approach, a majority of the portfolio is invested on a passive or low-risk basis, while a minority of the asset is managed aggressively in small satellite portfolios. The aim of the satellite portfolio is to generate a high active return with little regard to benchmark exposure, whereas the core is managed with low turnover and captures the long-term management in satellites can be executed with the objective of market timing. A drawback of this core satellite approach is that the assignment of asset classes, monies to actual portfolio managers and various expected alphas, risk surroundings these alphas, and correlation between the alphas can be seen in optimization process in its own rights, and outcomes in the process and is not necessarily consistent with the core satellite structure. Okay, summary. In this reading, we have discussed constructions of a client's investment policy statement, including discussions of risk and return objectives and various constraints that will apply to the portfolio. We have also discussed the portfolio construction process with emphasis on the strategic asset allocation decisions that must be made. The IPS is the starting point of the portfolio management process. Without a full understanding of the client's situation and requirements, it is unlikely that a successful result will be achieved. The IPS can take a variety of forms. A typical format will include the client's investment objectives and also a list of constraints that apply to the client's portfolio. The client's objectives are specified in terms of the risk tolerance and return requirements. The constraints sections covers factors that needs to be considered when constructing a portfolio for a client that meets the objectives. The typical constraint categories are liquidity requirements, time horizons, regulatory requirements, tax status, and unique needs. Risk objectives are specifications for portfolio risk and reflects the risk tolerance of a client. Quantitative risk objectives can be absolute or relative or a combination of the two. The client's overall risk tolerance is a function of the client's ability to accept risk and their risk attitude, which can be considered the client's willingness to take risk. The client's return objectives can be stated on an absolute or a relative basis. As an example of an absolute objective, the client may want to achieve a particular percentage rate of return. Alternatively, the return objective will be stated on a relative basis. For example, relative to a benchmark return, the liquidity section of the IPS should state what the client's requirements are to draw cash from the portfolio. The time horizon section of the IPS should state the time horizon over which the investor is investing. The time horizon may be a period during which the portfolio is accumulating before assets need to be withdrawn. Tax status varies among investors, and a client's tax status should be stated in the IPS. The IPS should state any legal or regulatory restrictions that constrain the investment or of the portfolio. The unique circumstances sections of the IPS should cover any other aspects of the client's circumstances that is likely to have a material impact on the composition of the portfolio. For example, any religious or ethical preferences. Asset classes. Asset classes that are building blocks in asset allocation. An asset class is a category of asset that have similar characteristics, attributes, and risk-return relationships. Traditionally, investors have distinguished cash, equity, bonds, real estate as the major asset classes. A strategic asset allocation results from combining the constraints and objectives articulated in the IPS and capital market expectations regarding the asset class. As time goes on, the client's assets allocation will drift from the target allocation, and the amounts of allowable drifts as well as the rebalancing policy should be formalized. In addition to taking systematic risk, an investment committee may choose to take tactical assets allocation risk or security selection risk. The amounts of returns attributable to these decisions can be measured. Okay, so that is reading 41. We'll have 19 more readings to go? Yeah, I'll have 19 more readings to go. Woo! Feeling good. Feeling hot. Feeling hot. You know who I am? I'm Michael Scott, bitch. Okay. Yeah, anyways. That's reading 41. We will continue into our reading 42 about risk management in our next section. I do hope our readings have been helpful. And remember, the show notes for the CFA Level 1 program curriculum, written by yours truly, is on Amazon. You guys could go there and check it out. Goodbye. Without further ado, have a nice day. Bye-bye.